Financial year 25 is in the bank and it's been one crazy year. In this video, I'm going to talk you through some of the broader asset classes that you could have invested in and how they performed. Now, keep in mind, past performance is not a reliable indicator for future performance. So just because some of these classes may have performed well in 2025 does not mean that they will perform at that same level moving forward. And fourth on this list is the ASX200, which is an index that tracks the top 200 companies on the Australian Stock Exchange. Now, if you wanted to invest in something that tracks the performance of these top 200 companies, there are a few ETFs you can buy. One is called IOZ from BlackRock. Another is A200 from BetaShares. Another is called STW by State Street. Now, all three of these ETFs will track the performance of the ASX 200, but each of them will have a slightly different management fee. So make sure you do a little bit of research on each one. The ASX 200 returned 10% growth in financial year 25. That's without dividends. And including dividends, it was a return of 13.81%. Not too bad. Not too bad. Now, one metric that's used to value stocks is called a price earnings multiple, or a PE ratio. Put simply, a PE of 10 means that you're investing $10 for every $1 of earnings the company generates. Or thinking about it another way, if you're spending $10 of a company and it earns $1 each year, it would take you 10 years to get your money back. So the ASX 200's average PE is between 14 and 16. That's what it is historically. And it's currently estimated to be sitting at a PE of about 19. So a little bit expensive at the moment. Now, the big banks were the driver of this performance of the ASX 200, with the Commonwealth Bank, CBA, responsible for 40% of the growth in the ASX 200. Coming in third on this list is the American stock market. The index is the S&P 500, which tracks the largest 500 companies in the United States. And this index is largely dominated by tech stocks, with companies known as the Magnificent Seven. There's a couple of ways you can buy ETFs to track the performance of the S&P 500. One is buying what's called an Australian domiciled ETF, and one example of this is IVV by BlackRock. The advantage of this is the Australian domiciled ETF means it's a stock that's listed on the Australian Stock Exchange that tracks the performance of the S&P 500 in the United States. The benefit of this is that from an Australian perspective, the admin is a little bit less because all the tax reporting and tax requirements are dealt with by the fund directly. To make things a little bit more confusing, there's an identical IVV listed on the United States Stock Exchange, on the US Stock Exchange. And nowadays, it's very easy to invest in companies in foreign jurisdictions. So you could actually buy the IVV listed on the American Stock Exchange if you wanted to. Now, this fund doesn't necessarily take into consideration the Australian tax requirements, so you may have to fill in a form with them known as a W8BEN form. And because it's listed on the United States Stock Exchange, it'll be denominated in US dollars. So there'll be some foreign currency risk there as well. Some other ETF options that you have are VOO by Vanguard and SPY by State Street. Now, the S&P 500 index had a return of 13% growth for financial year 25, that's without dividends, and with dividends it was a 15% return. And this index has seen a positive return since Donald Trump's Liberation Day announcements. The historical PE ratio for the S&P 500 sits at around 18, and it's currently estimated to be around 25. So again, a little bit on the expensive side. Now we move to the top two performers, and it's interesting that stocks as an asset class have not outperformed these two categories. Coming in at second on this list is gold, with a 41% return for financial year 25, which is the best return it's had for the last 10 years. It normally has an average return of about 6% per year. Gold is an asset class that people move to when there's economic and geopolitical uncertainty, when they're worried that their money will effectively lose value. So if you think in 2025, we had mass inflation. So it makes sense that gold would increase dramatically as a result of that inflation. We've also had economic uncertainty around Trump's trade policies, and if this would hurt investments, if this would hurt businesses, or it would actually improve them. And this, along with wars in the Middle East and the Russian-Ukraine war, it makes sense that gold's had a massive jump in 2025. And the winner for financial year 2025 with a whopping 74% return is, can you guess it? Bitcoin. Interesting though, this is a lower return than its previous 2 years, where it had 100% or over 100% return for the last 2 years. Some of the reasons for the return in Bitcoin is that it continues to gain popularity, especially among younger investors. Trump's support of cryptocurrency, including launching his own cryptocurrency. But the crypto space generally is still really volatile, and it's not for the faint-hearted. Let me know what you think. Will Bitcoin and cryptocurrency still get these wonderful returns moving forward? Now, I couldn't do a video on asset classes without talking about good old Australian housing prices. They increased by an average of about 7% in financial year 25, and with still the lack of supply and the increase in demand and support being offered by the government, some experts are predicting them to increase another 7% in financial year 26. Really hope you enjoyed the video. If I gave you some value, all I would ask is that you give the video a like. Really helps push my video out to other viewers. And if you made it this far in the video, I want you to comment below what your favorite asset class is from the ones that I've mentioned today. Thanks for stopping in. See you in the next video.